Hello and welcome to the world of official AI wealth hacks. This is the first of our 20 video series, Stock Market Beginner Masterclass. Chapter 1. What is the stock market and how does it work? Let me ask you something important. When you hear the word stock market, what pops into your head first? A secret club for millionaires, a high-stakes casino, or maybe something way too complex for beginners? Well, guess what? Those beliefs are exactly what might be holding you back from tapping into one of the most powerful wealth-building tools on the planet. In reality, the stock market isn't just a playground for the wealthy or a gambling den for thrill seekers. It's a dynamic, ever-evolving marketplace that allows everyday people to own pieces of the most influential companies in the world. Yes, you heard that right. You can literally be a part owner of household names like Apple, Tesla, or Google by purchasing their shares. And you don't need a Harvard finance degree or a giant bank account to get started. Over the next few minutes, I'm going to break down exactly what the stock market is, how it functions, why it matters, and how you can begin your investing journey, even if you only have a few bucks in your pocket. By the end of this video, you'll understand that investing isn't some mystical art reserved for the elite. It's a practical, learnable skill that anyone can master. So, buckle up because we're about to demystify one of the most important tools for long-term financial growth. We'll talk about the basics, the players, the myths, the risks, and the rewards. And trust me, once you grasp how the stock market works, you'll see opportunities to grow your money in ways you never imagined before. Ready? Let's jump right in. Alright, let's start at square one. The stock market at its core is a marketplace where people can buy and sell ownership stakes, called shares or stocks, in publicly traded companies. Think of it like your local farmer's market. But instead of tomatoes and cucumbers, the products on offer are slices of companies. If you purchase even a single share, you're officially a part owner of that business. The concept of the stock market has been around for centuries, with the first official stock exchange taking shape in Amsterdam back in the early 1600s. Over time, as economies grew and the Industrial Revolution kicked off, more and more companies started issuing shares to raise money for expansions, new projects, and research. Today, we have massive exchanges like the New York Stock Exchange, NYSE, and the NASDAQ in the United States, where thousands of companies are listed. Why do companies bother listing their shares on these exchanges, you might wonder? Simple. It's a way for them to raise capital. Instead of borrowing a huge sum from a bank at high interest, they can sell small pieces of ownership to investors. This influx of cash can help fund research, product development, hiring, and other growth initiatives. In return, investors gain the potential to profit if the company performs well. When a company thrives, earning higher revenue, profits, and positive market sentiment, the stock price tends to rise, rewarding shareholders. But of course, it's not all sunshine and rainbows. Companies can also falter. If they release a disappointing product, face stiff competition, or get caught in a scandal, investor confidence can plummet. This often leads to a decrease in stock price and consequently a decline in the value of each shareholder's investment. Essentially, the stock market is this living, breathing entity that mirrors collective investor optimism or pessimism about a company's future. Now, don't worry if all of this sounds a bit overwhelming. The key takeaway is that stocks represent ownership. Buying a share is like owning a small piece of that company's pie. If the overall pie grows, your slice grows in value too. If it shrinks, the value of your slice goes down. And the market, in turn, is just the grand exchange where all these slices get traded day in and day out. Whether you're a novice dipping your toes in for the first time, or a seasoned investor with years of experience, everyone meets in the same marketplace, guided by the forces of supply and demand. So, you might be asking, all right, I get that I can buy shares of a company, but who decides how much those shares cost? The short answer is the collective buying and selling decisions of millions of investors. Stock prices move up or down based on a tug-of-war between supply and demand. If a lot of people want to buy a particular stock, maybe because they're confident in the company's next product launch, the price generally goes up. If more people want to sell that stock, maybe because they read some bad news or lost faith in the company's leadership, the price tends to fall. Underneath these day-to-day fluctuations, there are factors like corporate earnings, macroeconomic conditions, interest rates, and even investor psychology. Good earnings reports, new partnerships, or strong economic indicators can spark a buying frenzy, pushing the stock price up. On the flip side, poor earnings, leadership shakeups, or negative economic forecasts can push investors to sell, driving the price down. Essentially, the stock market acts like a giant real-time polling machine. It continually aggregates the opinions of everyone from big Wall Street institutions to individual retail investors trading from their living rooms. All these opinions converge into a single indicator, the share price. Some people try to predict these movements by analyzing company fundamentals, looking at balance sheets, income statements, management teams. Others use charts and technical indicators to anticipate short-term price swings. Yet others simply invest in broad market indexes without worrying too much about individual stocks. In the United States, there are two primary stock exchanges, the New York Stock Exchange, NYSE, and the NASDAQ. The NYSE has a physical trading floor, famously located on Wall Street, where traders can shout orders in a lively pit, though electronic trading is the norm today. The NASDAQ, on the other hand, is fully electronic. Each company chooses which exchange to list on, often based on listing requirements, costs, and brand association. But don't let the variety of exchanges and all the financial jargon scare you. Online brokers have made it easier than ever to buy shares with just a few clicks. You can even buy fractional shares, meaning you don't need thousands of dollars to invest in a single share of an expensive stock like Amazon or Google. In other words, the market has become increasingly democratized. As a beginner, your job is to learn the basics, figure out your goals, and pick an approach that suits your risk tolerance and time horizon. Now let's talk about who exactly participates in this giant marketplace. First, you have individual investors, people like you and me who might decide to buy a few shares of a company we believe in. Then there are institutional investors like mutual funds, hedge funds, pension funds, and insurance companies. These players often trade in massive volumes and have the power to move the market simply by shifting their portfolios. Brokers act as the intermediaries. If you've ever used an online trading platform like Robinhood, eTrade, or TD Ameritrade, then you've already encountered a broker. Their role is to execute your buy or sell orders and sometimes offer research tools, educational materials, or even personal advice, depending on the level of service. Market makers are another critical piece of the puzzle. They're firms that stand ready to buy or sell shares at publicly quoted prices. Their job is to provide liquidity, ensuring that when you decide to sell 10 shares of Apple, there's someone on the other side to buy them, and vice versa. And finally, we have regulators like the Securities and Exchange Commission, SEC, in the US. Their job is to enforce the rules, promote transparency, and protect investors from fraud or other shady practices. But beyond the formal players, there's something arguably more influential that determines stock market movements: market psychology. Investors are people, and people have emotions. Greed can drive prices higher than logic would suggest, while fear can crash them. Headlines, social media chatter, economic data, these can all shape how people feel about the market on any given day. If enough people get excited about a particular tech stock, they'll pile in, sending its price up quickly. If panic spreads about a possible recession, you'll see a mass sell-off even if many companies' fundamentals remain unchanged. Understanding this psychology is crucial. The greatest investors in history, like Warren Buffett, often talk about the importance of staying calm and rational, especially when everyone else is losing their heads. Market swings can be wild in the short term, but over the long haul, the stock market has historically trended upward, reflecting broader economic growth. This is why learning to navigate these emotional tides and focusing on fundamentals rather than short-term hype can give you an edge in building lasting wealth. big part of understanding how the market performs overall is getting familiar with stock market indexes. You've probably heard names like the S&P 500, the Dow Jones Industrial Average, and the Nasdaq Composite. Each is basically a curated basket of stocks that represents a slice of the market. For example, the S&P 500 tracks 500 large U.S. companies across different industries, making it a decent gauge for the health of the broader U.S. stock market. The Dow Jones Industrial Average is older and more traditional. It follows 30 big, established companies. Even though it includes fewer stocks, it's still a widely watched indicator of market sentiment. The Nasdaq Composite focuses heavily on tech and biotech companies, which is why it tends to be more volatile when high-growth tech stocks swing up or down. Why do these indexes matter? Well, they give us a snapshot of how certain segments of the market are doing. If the S&P 500 is climbing steadily, that suggests that a diverse group of large companies is generally performing well. If it's tanking, it might indicate broader economic or market issues. Many investors choose to invest in index funds or exchange-traded funds, ETFs, that track these indexes, allowing them to own a tiny slice of all the companies in the index rather than betting on individual stocks. Index investing is popular for a reason. Historically, a well-managed S&P 500 index fund tends to deliver returns that beat most active fund managers over the long term. It's also simpler. You don't have to stress about picking which specific stock will beat the market. Instead, you're buying the entire market's performance. This approach can be a great entry point for beginners or anyone who wants a more hands-off, diversified strategy. Of course, indexes don't tell the full story. There could be sectors or individual companies doing exceptionally well even if the overall market is down and vice versa. Still, indexes give you a baseline. Think of them like a market weather forecast. Sunny skies might signal a general upward trend, while stormy conditions hint at more volatility. Either way, knowing how to read these signals is invaluable as you craft your personal investing strategy. So why do people bother with the stock market in the first place? Especially when there are so many other ways to put your money to work, like real estate, bonds, or even just a high-interest savings account. The biggest reason is potential for higher long-term returns. Historically, the stock market has outpaced inflation and delivered better returns than most other asset classes if you stay invested for a significant period. There's also something magical called compound growth at play. Think of compounding as interest on your interest or profits on your profits. Over time, your investment can grow at an accelerating rate because each year's gains can build upon the previous year's gains. An initial investment of, say, $1,000 can become tens or even hundreds of thousands of dollars if you give it enough time and reinvest your earnings, including dividends. Another big motivator is dividend income. Some companies, particularly well-established ones, pay out a portion of their profits to shareholders on a regular schedule. These payouts can be used to pay bills, reinvested to buy more shares, or simply tucked away as extra cash flow. Over the long run, dividends can significantly boost your total returns, especially if you consistently reinvest them. There's also an emotional and psychological benefit to owning a piece of a company you believe in. If you think electric vehicles are the future, you might invest in Tesla or other EV manufacturers. If you love technology, you might put your money in various software or hardware giants. This sense of ownership can make the investment journey more meaningful, though it's crucial to balance that enthusiasm with rational analysis. Beyond the numbers, people invest in stocks to meet life goals, saving for retirement, funding a child's education, or even just building a rainy day fund that outpaces inflation. By systematically investing in the stock market, especially in diversified portfolios or index funds, you're essentially betting on the long-term growth of the economy. Over decades, economies tend to expand, technologies advance, and new opportunities arise, which can translate to rising stock values. Of course, not every investor is in it for the long haul. Day traders and swing traders might be chasing quick profits from short-term price movements, but even they rely on the market's fundamental structure. It's a place where you can buy or sell a piece of a company with the click of a button, relying on liquidity provided by millions of other participants. For most beginners, though, The real power is in consistent, long-term investment strategies that harness time and compounding to build wealth step by step. It's not all rainbows and double-digit returns, of course. The stock market can be risky, and prices can swing wildly from day to day, or even minute to minute. One of the biggest mistakes beginners make is jumping in without a plan and then panicking at the first sign of trouble. They see a drop in a stock's price and assume it's time to sell everything, locking in losses. Then, if the stock rebounds, they miss out on the recovery. Another common pitfall is not diversifying. If you put all your money into a single hot tech stock, believing it can only go up, you're setting yourself up for a massive disappointment if that stock crashes. Diversification, spreading your investments across different companies, sectors, and possibly even asset classes, helps mitigate some of that risk. Even if one stock tanks, your entire portfolio won't necessarily implode. Timing the market is also a fool's errand for most people. Trying to guess exactly when to buy low and sell high is extremely difficult, even for professionals. There's a famous saying, "Time in the market beats timing the market." This means consistently staying invested over the long haul often yields better results than jumping in and out of positions in search of the perfect moment. Let's not forget emotional biases like greed and fear. Greed can prompt you to hold on to a skyrocketing stock for too long, only to watch it crash. Fear can make you sell during a market dip, missing the eventual rebound. Successful investors learn to manage these emotions, often by sticking to a disciplined strategy, like investing a certain amount of money every month, regardless of market conditions. Finally, there's the overarching economic climate. Recessions, wars, pandemics, all can wreak havoc on stock prices in the short term. But if you study history, you'll notice that the market, given enough time, has always recovered and gone on to reach new highs. This is why a long-term perspective is often emphasized. Short-term fluctuations might be scary, but they're part of the natural cycle of investing. So yes, there are risks, some of them substantial. But with research, diversification, and a bit of emotional fortitude, those risks can be managed. And remember, no one can predict the future with perfect accuracy. The best we can do is stick to a game plan, keep learning, and adapt as the market and the world evolve. So you're sold on the idea of investing in the stock market, or at least curious enough to try. The next question is, how do I actually start? Thankfully, it's never been easier. Step 1. Pick a brokerage. You'll need a brokerage account to buy and sell stocks. These days, there are plenty of user-friendly online brokers. Some are app-based, like Robinhood or Webull, which are very popular with younger investors. Others, like Fidelity or Charles Schwab, offer robust platforms with tons of research tools and excellent customer support. Look at factors like commissions. Many now offer $0 trades, user interface, customer service, and any account minimums before deciding. Step 2. Set your goals and risk tolerance. Before you drop a single dollar into the market, ask yourself, what's my objective? Are you saving for a down payment on a house in 5 years, or are you investing for retirement 30 years down the line? Your timeline and risk tolerance will shape your strategy. If you have a long horizon, you can afford to take on more risk because you have time to ride out market dips. If you need the money in a couple of years, you'll want to be more cautious. Step 3. Research and learn the basics. Familiarize yourself with fundamental metrics like price-to-earnings ratio, earnings per share, and return on equity. Understand what these numbers mean and how they can give you insight into a company's financial health. Read up on industry trends, economic news, and any specific companies you're interested in. Even if you plan to invest in index funds, it's helpful to know why those indexes might rise or fall. Step 4. Start small. If you're a true beginner, consider starting with an index fund or ETF that tracks a major index like the S&P 500. This gives you instant diversification across hundreds of companies. Once you're comfortable, you can explore individual stocks. Also, remember that many platforms allow fractional share purchases. This means you can invest $20 or $50 in a stock, even if one share costs $400. Step 5. Stay consistent. One tried and true strategy is dollar cost averaging. Investing a fixed amount of money at regular intervals, like every week or every month, regardless of stock prices. This approach helps you buy more shares when prices are low and fewer when prices are high, averaging out your cost over time. Step 6. Monitor and adjust, but don't obsess. Check in on your portfolio periodically to ensure it still aligns with your goals. However, avoid the trap of refreshing your brokerage app every 5 minutes. Short-term market fluctuations are normal. If you've done your research and have a long-term plan, daily ups and downs shouldn't rattle you too much. Step 7. Keep learning. The market evolves. New industries emerge. Think cryptocurrencies, biotech, renewable energy, and old stalwarts can fall out of favor. Subscribe to reputable financial news sources, watch educational videos, read books by successful investors, and even consider joining investment clubs or online communities where you can learn from others. Remember, the biggest hurdle is often just getting started. It's natural to feel a bit anxious about putting your money into something with no guaranteed outcome. But with a sound strategy, patience, and a willingness to keep learning, the stock market can become one of your greatest allies in building financial security and achieving your life goals. Congratulations! You've made it through the basics of how the stock market works, why people invest, and how you can start your own investing journey. By now, you should see that the stock market isn't some impenetrable fortress reserved for the wealthy elite. It's a tool, open to anyone who's willing to learn and take calculated risks for the chance at long-term gains. But before you go, let's recap the critical points. Stocks represent ownership in a company. Buy a share, and you're literally a part owner. The market's driven by supply and demand, influenced by everything from a company's earnings to global economic factors, and yes, even investor emotions. Long-term investing harnesses compound growth, turning even small, consistent contributions into potentially significant sums over time. Diversification and emotional discipline can help manage the inherent risks in the market. Getting started is easier than ever, thanks to user-friendly online brokerages and the availability of fractional shares. Now it's time for you to take action. If you're serious about building wealth and securing your financial future, consider opening a brokerage account, doing some research, and dipping your toes in. You don't have to be an expert right away. No one is. Keep learning, stay curious, and treat your investing journey as a continual process of growth. If you found this video helpful, do me a favor. Hit that like button, share your thoughts in the comments below, and don't forget to subscribe. We've got plenty more content coming your way, from beginner-friendly tutorials to advanced investing techniques. By subscribing, you're joining a community of people determined to take charge of their financial futures. Remember, the key to success in the stock market and in life is persistence, patience, and a willingness to adapt. The sooner you start, the more time your money has to grow. So why not begin today? Go ahead, invest in yourself and your future. Thanks for watching, and I'll see you in the next video.